After several weeks of sideways consolidation, Bitcoin's price structure has finally shown signs of significant movement. In this video, we'll approach the situation from a technical analysis perspective and focus on one key question. Is this recent drop a false breakout or the beginning of a true trend reversal? Toward the end of the video, I'll also highlight several critical levels and structural signals you need to watch closely so you can stay ahead of the market's next move. Through technical mapping, we've identified a key structural pattern. Put simply, the current move can be interpreted as a retracement following a breakout above the previous high at 111,917. Price has now pulled back to retest this critical level and is showing early signs of a rebound. But does this rebound mark a continuation of the uptrend war, the beginning of a deeper correction? Let's break down the signals behind this move to find out. From the current chart, we can clearly identify two key structural patterns. First, the market is forming a secondary correction structure, characterized by lower highs and lower lows, indicating that bearish momentum is still in play over the short term. Second, we previously saw a breakout above the prior structural high, followed by a retracement, with price now retesting that breakout level as potential support. These two formations reflect a classic tug-of-war between trend continuation and correction pressure. This type of price movement is commonly referred to in Elliott wave theory as a complex corrective structure, particularly a combination of a flat correction followed by a zigzag pattern often seen in transitional phases. In Wyckoff methodology, it can also be interpreted as a classic sequence of distribution, upthrust, and subsequent pullback. The key point here is that price is currently retesting the previous breakout level, a phase we often refer to in technical analysis as the breakout pullback confirmation process. If price stabilizes in this zone, while momentum indicators begin to strengthen, a new upward leg could be initiated. Otherwise, we need to be cautious of a false breakout, which could lead to a secondary decline. To reach a more accurate conclusion, we begin by analyzing the first structural phase. From the chart, it is clear that during this stage, Bitcoin's price exhibited a secondary corrective pattern characterized by both lower highs and lower lows. This is a classic sign of structural weakness, indicating that every rebound lacked sufficient bullish momentum to break above previous highs, while each pullback pushed the market to new local lows. This suggests that bearish pressure remained dominant, with price action largely controlled by selling momentum. However, this pattern experienced a notable shift on June 22, 2025, when the state of Texas officially signed into law the Texas Strategic Bitcoin Reserve Act (SB 21), becoming the third U.S. state to legally establish a Bitcoin reserve. This policy marked a macro-level, institutional tailwind, significantly enhancing Bitcoin's legitimacy at the state level and providing long-term confidence in its role as a reserve asset. At the same time, the Federal Reserve's meeting minutes hinted at a potential rate cut later in the year, and the U.S. dollar index DXY began to pull back. This combination of regulatory optimism, dovish monetary policy expectations, and dollar weakness provided ideal conditions for risk assets to rally. As a result, Bitcoin structurally broke above the key resistance at $111,917, the previous high from the first phase, thereby initiating the second phase of bullish price action. In this context, the transition from the first to the second structural phase can be interpreted as a sentiment-driven reversal, triggered by external news flow, a shift that left behind a clear breakout signal on the chart. Therefore, we need to pay close attention to a critical structural issue. During the first phase, BTC did not exhibit a clearly defined bullish base. In other words, although the market managed to break above the previous high, the breakout lacked structural foundation and was instead triggered by external news-driven momentum, a rapid surge without underlying consolidation. Historical patterns have shown that when a rally lacks a gradual buildup of higher lows or sustained buyer support, any failure to hold above a key support level in the retracement phase often leads to deeper corrections or even sharp liquidation of short-term positions. This same behavior can be observed in the US dollar index, DXY, during the period from October 3, 2023 to September 23, 2024. Within that time frame, the DXY also formed a classic bearish structure, marked by lower highs and lower lows, indicating persistent downward pressure. Then, on September 23, 2024, the index reversed sharply to the upside, driven by four macro-level bullish catalysts. A surge in global risk-off sentiment, continued outperformance of the U.S. economy, capital flows back into the U.S. dollar due to trade dynamics, and diminished market expectations for an imminent Fed rate cut. This confluence of factors caused the DXY to break above previous resistance and initiate a strong rally. However, it's important to note that this upward move also lacked a solid accumulation base, relying heavily on external catalysts. Once the DXY broke below the 106 to 107 support zone, bearish momentum intensified sharply, triggering a wave of heavy selling and ultimately resulting in a steep decline. This pattern can be interpreted as a fragile rally built on short-term positions that lacked durability. Once upward momentum faded or external conditions changed, these unstable long positions rapidly unwound, leading to accelerated downside pressure. Applying the same logic to the current BTC structure, we can say that the breakout above $111,917 was not supported by a structurally rising base. If price fails to hold above the $111,917, $110,527 key zone, the short-term trend structure will likely lose its support foundation. Furthermore, the concentration of short-term capital at the highs could amplify liquidity risk, increasing the likelihood of a secondary dip, much like what we saw in the DXY pattern. As a result, the 111,917 to 110,527 zone becomes a reinforced technical boundary not only as a reference for trend confirmation, but also as a structural firewall for price stability. We now shift our focus to examining the bullish phase of the market, beginning with the breakout that occurred on July 10, 2025, when BTC price surged above the critical level of $111,917. On the first trading day following the breakout, the market continued to push higher, accompanied by a moderate increase in trading volume. Notably, the price gain on this day exceeded that of July 9th, suggesting that bullish sentiment had begun to consolidate, with buyers showing stronger conviction behind the move. However, on the second day after the breakout, the price increase narrowed significantly, even though trading volume continued to rise. This divergence between weaker upward momentum and expanding volume signals the first appearance of meaningful disagreement between buyers and sellers in this bullish leg. Simply put, more participants were entering the market, some expecting further upside, while others began taking profits or initiating short positions. This conflict of sentiment created a clear inflection point. The daily low of that session becomes particularly important, as it marks a key level where this battle between bulls and bears intensified. We can now label that low as a structural support reference, which may play a decisive role in future price validation. The second major volume spike occurred on July 14, 2025, when Bitcoin tested its all-time high at $122,054. However, the move was met with clear selling pressure, as indicated by the long upper wick on the daily candlestick. This price action suggests that despite strong buying interest early in the session, sellers stepped in aggressively near the highs, absorbing demand and driving the price lower by the close. The wick formed on this candle highlights a critical supply zone between $119,716 and $122,054. This zone now serves as a key resistance area, where significant selling previously occurred. If the market attempts to rally again, price behavior within this range will be crucial for determining whether the bullish trend can continue or if another rejection is likely. Let's now highlight the resistance zone in red and take a closer look at how this area influenced market behavior in the following trading sessions. As we can see, the market made multiple attempts to break above this red resistance zone, but none of them resulted in a sustained breakout. Each rally into the zone was rejected or quickly sold into, confirming that selling pressure remains active between $119,716 and $122,054.86. This behavior validates the area as a structurally significant supply zone, where market participants are consistently taking profits or initiating short positions, limiting further upside momentum. Between July 10th and July 31st, 2025, the market traded in a well-defined range, oscillating between the bullish support level at $114,354 and the resistance zone between $119,716 and $122,054. Within this consolidation range, we also identified a secondary low, which allows us to define a more precise, bullish defense zone between $114,354 and $115,701. This zone is now marked as a green area on the chart, representing the range where buyers have actively entered the market to absorb selling pressure. After July 31st, on August 1st, the market saw a high-volume breakdown below the bullish support zone between $114,354 and $115,701, signaling the end of the previous consolidation phase. However, on the following day, August 2nd, sellers did not follow through with further downside momentum to test the next key support zone between $110,527 and $111,917. In fact, trading volume dropped off significantly, and this low-volume environment has now persisted for 4 consecutive sessions. This suggests that the market has now entered a neutral phase, where no dominant buying or selling pressure is present, and price action is more likely to follow technical trading behavior rather than being driven by large players or news catalysts. We can already see signs of this shift. A technical rebound forming near $111,917, and visible short-term resistance around $115,701. As long as no new external catalyst or strong directional flow enters the market, we can temporarily treat this as a range-bound environment, with trading activity oscillating between these two levels. To help visualize this, I've marked the upper, middle, and lower zones on the chart using 3 different colors. If you'd like a more detailed breakdown or exact strategy setups for this phase, you can find the full analysis over on my page. Before we wrap up, I just want to let you know, I don't actually speak. The voice you're hearing is AI generated, but every chart, every structure, and every idea you've seen here, they're all my own work. If you found the analysis helpful, I'd really appreciate your support. Like, subscribe, or check out the full strategy breakdown on my page. Thanks for watching, and remember, this is exactly where technical precision matters most. You don't need to guess, you need structure.